Guys, is again, I'll give it about one more minute, and then I'm going to play a short little video. It's interesting how things happen in our lives where you run across something, and I've got something personal going on in my wife and I's lives currently, and I didn't know a whole lot about a topic that I ran across a video that was completed by, wouldn't you know it, a guy by the name of Chris Naugle. So it's a little bit long. It's about 8.5 minutes, but I am going to play it. And then my guest today, Amy Lister, who was on our first episode a couple weeks ago, a CPA out of Utah with Better Accounting, and she'll be joining us shortly. And we're going to tie this video into that my personal thing that's going on, and we're going to talk about it from a tax strategy. And then there's been a number of questions that have came in over the last couple of weeks that I'm going to have Amy hit on also, and I'm sure that you guys will have some additional questions today. Where are we at? 109. Let me share the screen, and let's watch this little video here by our own great guy, Chris Naugle, and then we'll get through my monologue of the day, and then we'll get Amy here tied in to answer some questions and talk about some tax strategies.
Airbnbs, maybe want to invest in your own Airbnb, but maybe you're just not sure where to start, how to maximize those returns and minimize the risks in a fast-changing landscape. It's changing very fast. Well, let's dive into it, because you're not going to want to miss this video. I'm going to give you some of the tips, some of the things that I've learned from lending on Airbnbs and also having friends that invest in them. And I'm going to give you the inside scoop on how to succeed as an Airbnb investor. The first thing that you really need to understand with an Airbnb is you got to identify the best places to invest in Airbnbs. Now, let me be clear. I live in Buffalo, New York. I'm not saying this is a bad place to do Airbnbs, but our taxes are high. And I don't know. I mean, there's just not a lot of people looking to come to Buffalo when it's a blizzard. So this might not be the best place to invest in Airbnbs if you don't live here. Find areas that people want to go to. Find areas that people are going to where they might be looking for alternatives. The second thing you really need to do is you got to analyze the Airbnb. This is, I think, during the big upswing in the price of real estate, analyzing Airbnb investments, I think, is where a lot of people fell short. Because really, it was kind of like throwing a dart at any property in a good area. You knew you were going to be able to make money on an Airbnb, but that was because it was revenge summer. People were just coming out of being locked up from the pandemic, and they just wanted to get out there. So Airbnbs were going through the roof, but now they're settling back down. And if you had done your proper analysis of the Airbnb investment, and you had looked at the real estate data in each market, well, you would have been able to figure out that, hey, this might not be a sustainable model at these prices. Even after you've chosen the city, it's really important to analyze the factors within the city that can make your investment soar or fail. Things like competition, zoning laws. How many other Airbnbs are there in your area? Is every house an Airbnb? And why would yours stand out above all the other ones? A lot of zoning laws don't even allow Airbnbs, and you're seeing this more and more. What is the average daily rate? They call it the ADR. Well, and is the average daily rate inflated because the market's inflated? So I always like to say, if you got an average daily rate, reduce it by 20%, maybe even 30% in certain parts. The other thing you want to factor is seasonability. Virtually all markets have a high and a low season. Let me ask you this. Are you going to come to Buffalo for a vacation in the middle of winter when we just get snow and negative temperatures? No. Are you going to go to Arizona right in the peak of summer when it's 110 degrees? Have you ever taken a magnifying glass and you put it on an ant? Gone. That's what Arizona's like in the summer. Do you want to be there then? No, I doubt it. So that's their low season. So all these factors, all these things play into whether or not an Airbnb in a specific area is going to be good. And you got to factor that into your numbers. This is especially true for destination markets like lakeside retreats, ski towns, and beach towns. Think about this. When the hurricane came through Florida and hit Tampa, what if you had a couple Airbnbs pretty close to the beach or not even close to the beach, and that hurricane crushed your properties? Chances are you couldn't get insurance that covered hurricanes. So it could be a total loss. How do I know this? I know a lot of people that went through that. It's very sad. They had beautiful Airbnbs. They were making tons of money, almost like printing money. One hurricane, totally out of their control, wiped out. No insurance money because the insurance companies won't insure against that. Are you factoring this into your plan for your Airbnb? The other thing you need to do is you need to compare Airbnb investment opportunities in multiple markets. So do a market comparison, a market analysis, and that should reveal the trending revenue and the occupancy numbers for each market that you explore. So wherever you're at, whatever market you're looking in, you should be able to easily find these numbers. Are you seeing a decline in certain areas? Are you seeing that seasonability? Once you dive into this, you will. If you haven't settled on a city or a zip code to invest in, you can enter up to 4 locations at the same time and compare Airbnb revenues. You can compare occupancy rates. You can compare the rate of growth or the rate of decline. Even after you pick the city, you can use market comparisons to drill down to the top performing zip codes, because each area, let's face it, right? If I just said you want to be in Dallas, there's different zip codes. So you can really drill down and get really specific about your analysis and about these numbers by zip codes. You can also look at property sizes and try to maximize the revenue and make the max amount of profit that you can on each Airbnb. You also need to estimate your Airbnb investment income. Now, like I said, when everything was going good, it was easy to. Every Airbnb was making money, but right now it's getting tough. I know a lot of people that overpaid for properties because they bought them at the high. They put tons of money, the best furniture, and some of those Airbnbs had some issues. They had break-ins, their vacancy rates are going up. So when you did the analysis, did you factor these things in? Well, that would be estimating your Airbnb's investment income and run it on the downside, 20 to 30% off. The fifth thing you should really consider is strategically price your Airbnb. It's important to remember that there's no single rate that's right for any property or any Airbnb. The daily rate that you offer, it changes. Sometimes changes by the day, sometimes by the week, sometimes by the season. And it really changes by supply and demand in that market. A successful pricing strategy would adapt to all of those different factors. The high season, the low season, it would factor all that in. But this takes a lot of work, doesn't it? Oh, you thought Airbnb investing was easy. Well, you know what? It's not. Airbnb investing is not easy at all. It requires all this stuff. You got to factor all these conditions in. So maybe what you should do, if you're really looking at Airbnb investing, go back to the beginning of this video and start taking some notes. I can give you a quick recap. Let's go back to the top. The first thing when looking at an Airbnb that I mentioned is to identify the best place to invest in for Airbnbs. Then I said you got to analyze the Airbnb investment. You want to look at the real estate data for each market. So even after you've chosen a city, it's important to analyze all the factors within that city that can make your investment soar or fail. Don't buy an Airbnb in an area where there's zoning laws against Airbnbs, or there's a ton of competition, or the ADR, the average daily rate, is not what you want it to be. Also, seasonability is an important thing to factor into your analysis of where you want to do. There's a lot of markets, actually all markets have a high and a low season. Are you considering that? Or are you just going there when you're on vacation saying, oh my God, this is so beautiful, and then you didn't see the bad season? And also, if you're looking at destination markets, lakeside retreats, ski towns, beach towns, factor in that. That's big. There are high and low seasons that swing drastically. The other thing we talked about was comparing your Airbnb investment opportunities in multiple markets. And this is easy analysis to do. You can compare up to 4 different properties. And once you find those 4 different properties, you can drill down by zip code and you can look at them and you can really compare the revenue, the occupancy, the rate of growth or the rate of decline. You can even pick up whatever city and you can really drill down to the top performing zip codes in those areas. And that's going to help you maximize your revenue and maximize your profitability. Also, estimate your Airbnb's investment income. Factor the low side and the high side, blend it out. And then strategically price that Airbnb. So if you're at the point where you have it, you got to remember there's no single rate that's right. The daily rates change all the time. They change based on seasons. They change based on supply and demand. They change based on all sorts of things, and you need to factor that in. So folks, I hope this gives you a little bit of a baseline for when you're considering Airbnb investing, because I know a lot of people jumped into this, and I know there's going to be a lot of people that are going to get hurt, which is actually an opportunity for some of you watching this right now.
All right, guys, wanted to share that with you. I know it was a little bit long, but sorry about that. But I thought Chris did a really good job, and the fact that he recapped it, just kind of wanted to share that with you. And before I get into the monologue and get into some Q&A and bring Amy on, the reason why I share that, we all go through different investment challenges and whatnot. And, personally, for my wife and I, we actually own a condo here. I kind of inherited it when my mother passed away, and then it became a little bit of something that I didn't want to be a landlord, so I sold it, but held the paper. A young couple couldn't get financing, stuff like that. And long story short, after 3 years of them writing me a check and then me paying down a mortgage and all of that stuff, they decided they didn't want to be there anymore. Difficult situation. So after 3 years, I ended up inheriting this piece of property back. Couldn't be in a better market. If you don't know, I'll make fun. I don't live in Buffalo, and there's certainly not going to be a blizzard coming in Gainesville, Florida. But that's where I'm at. I'm in Gainesville, Florida, where the University of Florida is. It's a huge college town. I'm a Gator, and couldn't be in a better area. And I know nothing about Airbnb. One of my best friends is arguably the #1 real estate person here in town. So I ran that by him. He's like, yeah, you definitely need to Airbnb it. I'm thinking about renting it, whatever it may be, and ran across this video of Chris, and just, everything's about timing. And it was just an interesting video. Wanted to share it with you, talk with Amy a little bit about it from a tax standpoint. And obviously we talk a lot about real estate investing here at the Money School. So again, just want to share that. And when Amy comes on, we'll talk a little bit about the tax advantages. By the way, Alex, thank you for the Go Gators. Love you. And we'll go from there. So with all of that said, let me jump in. Where'd February go? That's that I woke up today and went, oh my gosh, it's the last day of February. So I don't know about you, but 2 months of the year just gone in a blink. So, before I jump in there, the way, welcome everyone again to this week's episode of Shey's Way, where we talk about all things regarding protection, investment, and everything comes with a tax component to it. Regarding your current planning for today, tomorrow, and generations to come. So when I talk about that, remember, we're always going to lay out the truth, the facts, and how and what we believe regarding running against the herd of what everyday society tells you should be doing with your money. We're going to press you on the conventional wisdom. We believe that the conventional wisdom is wrong. It's not difficult when you're talking about planning or retirement or anything like that. The world has complicated that, and but it's not. It's protection, investment, and taxes. It's no more complicated than that. And as I was preparing for this, I was thinking about, this is what we get an opportunity to do every week. We get an opportunity, Chris, the Money School team, the Money Mentors, Amy, our different affiliate partners. We get the opportunity to work with people all over this great country that whether it be a protection component, an investment component, taxes, whether it be, you sold a condo and ended up getting it back 3 years later, that's life, right? So we're all trying to do the best that we can. And before I move over into the task component and bring Amy on, I was thinking about, 2023, planning is cooling off. Because as all of us kind of come into a new year, you get excited, you start reevaluating your personal life or your business life, and maybe it's maybe you need to get some insurance, maybe you're looking at another investment. I know that's what I've been doing, thinking about different investments and different real estate. And I wrote 2023 planning is cooling off. Don't lose your momentum. We're going to tie in the video that Chris did, but I just wanted to bring these couple things up. Estate planning. 9 out of 10 people, or about 91% of the American population in this great country of ours, does not have an estate plan. They don't have a will, a living will, durable power of attorney, healthcare directives, pour over will, or a revocable living trust. Why? 91%. goes back to the thing that all of you heard me talk about. All perfectly healthy, psychologically well-adjusted human beings are in denial of their mortality. And that's why no one does it. So, but when you start thinking about generational wealth, I was watching a television program. I don't know if anyone else is a Yellowstone 1923 thing, but it was in the 1923. A gentleman said, generational wealth is the closest a man or a woman can get to immortality. And it's something that I've been thinking about, creating generational wealth, creating something for my kids and my grandkids to be able to walk into, not a silver spoon, but something to leave them. So the question is that I'm posing to you is, what are you doing to create generational wealth? And I'm not asking that in the chat. I'm just trying to get you to think, what are you doing to create generational wealth? Then the next question is, what are you doing to guarantee tax efficient transfer of the wealth that you spend a lifetime creating? Because it's one thing to create generational wealth or create wealth. It's a whole different thing to transfer it across generational lines as tax efficient as possible without the government taking their chunk of it. So just a couple questions I want to pose to you, just to keep thinking about it. It's a Tuesday afternoon. You got at least a week to think about it. And then if some different questions or whatnot, we can hit that. Let me give you the disclosure. The material shared today in the webinar prepared for informational purposes only. It's not intended to provide tax, insurance, investment advice. You should not rely on it. Again, this is the litigious world that we live in. For tax, legal, kind of advice, consult your people. If you don't have people, get with one of us and we'll get you in touch with the right people that can help you. So I just want to share that with you. I know Amy and Chris were both on calls. Amy, hopefully you're finishing that up. So let me give you a little bit of backdrop on Amy. I'm sure she'll be coming in here in a second. She's the president and tax director of Better Accounting. She's out of, I'm going to just say it's Salt Lake City, Utah. I know it's some little town there, but she's got 20 plus years of extensive accounting experience and tax knowledge. Her firm works with many business owners all over the country and individuals. She also specializes, well, one of her big specializations is she helps clients in tax planning and tax strategies to minimize the tax liability, which is everything about this show that we want to look at, whatever it is, investment, insurance, real estate, what alternative investment, whatever we're talking about, we always want to come back and deal with the tax component. So with that said, welcome Amy Lister with Better Accounting out of Salt Lake City, Utah.
Thank you. Thank you, everyone. Let's go ahead and hit on that Airbnb. The one thing that you have to think of when you do an Airbnb, it can be considered a small business, but it also can be considered just a rental, a short-term rental on a Schedule E. So the difference between there, how do we differentiate that, is the services you offer. So if you are more like a hotel or a bed and breakfast where you offer breakfasts, offer cleaning every day, those types of offerings, then it is considered a Schedule C, small business, self-employment taxes. The way I always refer an Airbnb is make it so it's still the passive. So still a short-term rental, and you're gaining that income at a much faster rate than a long-term, but don't offer those services. Just make sure that you have enough cleaning supplies on hand so you can extend that service for however long they're staying. Just make sure you have the supplies there that needed. Offer a little bit of like granola bars, or like I just stayed in an Airbnb just a while back while we went to a basketball game, and they put waters in the fridge and they offered candy bars sitting there for snacks. So just do little things, do like little coffee thing, like Keurig, those types of things. That's the way it stays on the passive side, but you're still offering amenities. And then you get to depreciate it and act like it's just considered a long-term rental, but it's classified as a short-term. So there is the big difference, is keep it on that passive side.
Awesome, Amy. I'm not cooking breakfast by any means if I turn my my condo into an Airbnb. So there's no risk of that by any means. I mean, anything else on Airbnb that would help us?
And honestly, working with real estate professionals across the United States, do a mixture of long-term and short-term, because sometimes the cash flow kind of helps out in those hard times where that Airbnb is not being rented out. So always have a mixture of investments. Like always, you don't want to put everything in an Airbnb. So you have 6 Airbnbs and then nothing else in those slow times. So I always say mix it up a little bit depending on the area that you're looking in.
Okay. Let me throw this out there because, well, I mean, it's no secret. I work with Amy and all of her firm, and one of her great employees is Rachel, and I work personally with Rachel on a day-to-day basis. And I was running some of this by her, giving her the whole diagram. I mean, you almost have to draw an organizational flow chart of how I ended up with this condo, because I had it and then I didn't have it, and then my brother and I owned it, and then all kinds of different stuff. But one of the questions I have there is I think you guys need to try to figure out my basis in this thing. And then one of the questions I have is, because I have an LLC that holds a commercial building. After I own this thing 100%, should I put that inside that LLC, Amy, or should I open up a separate LLC to hold the residential real estate?
So my advice for that, so basis. When you inherit a home, you can go off of fair market value at the time of the inheritance. So you get an up in basis for that purpose. So we can do that. So at the time that you actually inherited it, that's the basis we're going to go off of. Plus, we're going to add in any repairs that you have to do to that, because I know the renters did not leave it in a nice fashion.
Right.
And so we're going to putting some money into it. So we're going to count that as well. We're going to do more of a cost analysis on those repairs. That way we can see if we can expense them off, as well as maybe put them into different categories. So we don't have to lump them all into that 27 and a half year depreciation. So we're going to try to break it up a little bit. So that is what we're going to be doing for Brian.
I have a limited liability company that houses a commercial building. Can I put the residential into the same LLC, or would you advise me to open up a separate one?
So I try to keep them separate because your liabilities are a little different. You have more of a chance of someone suing you in your residential than you do in your commercial. So I don't want them having access to that commercial. So I try to group residentials in same states and based on how big the asset is. You don't want to put all of yours in lump sum. So once you reach right around, I say about the 4 to 5 houses that you have, I say open another one, because the houses are worth more now than they did back in the day. So always have a separate LLC. Don't want to include it in with your commercial just for liability purposes.
Okay, awesome. Thanks, Amy. Hey, there's been a number of questions that have come in over the last 2 to 3 weeks that we've been doing this particular webinar. And before I jump into those, I wanted Amy to talk a little bit about one of the tax changes this year in regards to automobiles. So I'll be quiet and let her hit that real quick for people.
Okay, so the IRS has decided to not do 100% bonus on those bigger over 6,000 pound vehicles. So we have to be super careful. There is still a way we can expense off the whole amount. We just have to finagle it a little bit. So to do bonus, they have limited that to 80% of the value of that vehicle that you purchased. So the way I have come across a way to still take the 100% is to actually bonus 80% of it, but then the other 20%, I'm going to 179 it. So still taking that 100%. When you do go to sell or dispose of this vehicle, the tax, it changes a little bit. So you will see it on your tax return. It won't pass through to your individual as much, but that is how we can still take the 100%, but we're just going to kind of split it up a little. So if your depreciation looks a little different on your tax returns, that is the reason why. So we're still using it. Now, the smaller vehicles, they have always been limited. You have never been able to take 100% of those smaller vehicles. So they have increased that limit to 2,200 instead of 19,200. So there is a little bit more. They have increased that limit, but everything else stays the same. So they're kind of messing with that bonus depreciation, putting limits on it, even with other machinery and furniture and, other equipment. So just beware of that. Please ask your, CPA how that will affect you, that type of thing.
Okay, awesome. Thank you. Before I jump in, let me preface, there's a couple questions that have come in, and I just want to preface this before I throw them at Amy and let her answer a couple of these. The conventional wisdom talks a lot about using qualified plans, traditional IRAs, SEP IRAs. I know that there's a whole lot of talk through the money school about self-directed IRAs, 401k plans, qualified money. One of my deep beliefs is, I believe marginal income tax rates are going to be higher in the future. And I have a very strong belief that if I put 100 people in the room and ask that question, do you believe marginal income tax rates are going to be higher or lower in the future? I think you're hard pressed to find more than 2 or 3 people that would say tax rates or marginal tax rates are going to be lower than they are today. So when we start talking about qualified money, whether it be a 401k plan, a 403b, traditional IRAs, SEP, simple stuff like that, we always end up coming back to talking about Roth conversions. So I want to preface that. And here's question number 1 for you, Amy. Came in about a week ago. How much can I contribute to my IRA in 2023?
Okay, so that has gone up just a little bit. You can contribute up to $6,500 to a traditional or a Roth with additional $1,000 catch up. So that has increased by $500 this year for that.
And I could have lumped this in here, but it was a carryover from that question. In addition to the IRA, if you have, in addition and or if you don't have that, if you have a 401k plan or a 403b plan, what are your contribution limits for this year on that?
Okay, so it has increased up to $22,500. You can do additional $7,500 if you're over that threshold of 50 years of age. So through your job. So that will actually help those people catch up a little bit. One thing that I know me and Brian were talking about beforehand, double check your plan to see if you can actually transfer those funds into and throw them into a Roth instead, just because that will save you money in the long run. Like he said, back, when you get ready to retire, let's see how much funds you have that you can just pull out rent, tax-free instead. And
let me piggyback on that here real quick. One of the things that I believe I said in episode 1 of this show is if you're working with a CPA or some accounting firm and you're talking to that accountant or that firm or your person every November, I don't consider that as tax planning. I don't consider that as tax strategy work. You should be talking to or working with some type of CPA firm that is doing comprehensive tax strategy planning. When we talk about doing Roth conversions, and Amy just made a good point, you may have a 401k plan through some employer, or maybe you're the business owner and that you've put it in. You need to go back and look at your plan documents and find out whether or not you and or people that work for you are able to do in-service conversions. So it may be a 401k plan. There's a lot of those plans out there that will allow a Roth conversion while the plan is in service. And then there's some that just that don't allow it. When you think about doing tax forecasting work, August, September, when you're getting ready, but you've done some things during the year, depending on what the tax strategies that you're looking at, you may be able to contribute, $30,000 into your 401k plan, or even more than that into a SEP IRA if you're an individual business owner. And then by the end of the year, it may make sense. Again, it may make sense for you to look at the marginal tax rate that you would have to pay by doing some type of conversion. And just to use easy numbers, we talk about if you're doing good tax planning work and you're able to maybe convert $100,000 out of a traditional taxable environment, move it over to a Roth, and let's say you've got to pay 20% tax on that. So that's $20,000. You have to ask yourself, when are you going to be in a 20% tax bracket? And if you can convert 100 from traditional IRA over to a Roth and now invest that 100 grand in a tax-free environment, never pay any more taxes, not only on the cost basis, but no tax on the growth either. Is that a better environment for you to be in if you believe tax rates are going to be higher in the future? Okay. Amy, did I misspeak there at all?
No, not at all.
Okay.
I actually have a lot of conversations, even throughout the year, just saying, hey, my business is at this. Is there a way that I can convert, from an IRA to a Roth? And we run the numbers and we just kind of plan ahead, because you do have to make that election by 12/31. Now, whether you actually complete that conversion and you decide, oh my goodness, I can't do that, you can back out of it, but you have to make the election to move those. If I remember correctly. Is that correct, Brian? Do you know?
Yeah. No,
Yes.
you do. Yes.
So you do have to make that election. So waiting till, February, like I just talked to probably about 3 or 4 clients while I was prepping their tax return, that they wanted to do that now because they have the tax liability that they could have swallowed up some of those taxes. It's not available to them right now. We should have planned in November for that conversion and then made the decision right now. Is it still feasible for you to do that once all the numbers are in? So please plan ahead. So we're actually planning ahead. We're going to do it in June this year with 2 or 3 of those clients. And we're going to plan ahead and see if we can just kind of stockpile, see how much we can convert over. So it can happen throughout the year as well.
Yep. And last point on that. Well, my last point on it is, when you're working and you're doing comprehensive tax strategies, there's probably going to end up being a sweet spot where it may make sense to convert 80 grand rather than 100, because then it just bumps you into a different tax bracket. And there's going to be that sweet spot that we can figure out where this year it may make sense to do 80 and next year it may make sense to do 120. But there's a tremendous amount of assets that are held up in what I call locked up in traditional IRAs or 401k plans that, again, whenever the government's going to need that money, all they have to do is change the laws and tax it a little bit different. So just be cognizant of that. High income earner question here, Amy, for you. How much do I have to earn in 2023 before I can stop paying Social Security tax on my salary?
Good question. So this changes every year because the government realizes everybody's making more money. So they have increased your wage to be $160,200 this year, where last year it was at $147,000. So they have increased a considerable amount this year. Normally it's not that much, but they have increased it to $160,200 this year that you have to pay Social Security on.
Okay. All right. Once again, the government trying to tax us more. Hey, by the way, I threw something in the chat because last week I completely forgot to say, hey, if you need additional information, if you have additional questions, if you want to schedule a one-on-one call or whatever it may be, hit the link. I posted that link because I know in about 10 minutes when we close this thing out, I'd probably forget to do it. So I just threw it in there earlier than I guess last week because I didn't even do it. This one's a little bit detailed, so I'm going to throw it out here. I'm going to read this slowly. On my last income tax return, my itemized deductions didn't exceed my standard deduction. What's my standard deduction for 2023?
Okay, this one's a little more in depth. Okay, for single filers, if you are single, that amount is now $13,850. So that it's gone up a little bit. Probably, I think it's close to $1,000 from last year. For couples, you will get $27,700 this year. So a lot of people that used to be able to use their homes for itemized deductions, this is going to really hurt them. So contributions are good. They're always a write-off. So if you have a local charity, always try to do that along with that always helps you bump up over to the top of that. Then head of household people will get $20,800 this year. So everything's gone up, but probably right around $900 to $1,000 for those itemized deductions on each level.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Amy, gifting. Again, high income earning, people that want to gift money. Where are we at on that on 2023?
So 2023, you can contribute, gift over to your children $17,000. That has only increased $1,000, so it's not a huge bump, but at least it's something to kind of help gift that extra money over into your children's or grandchildren's accounts instead of your own. Great way to save on money.
Does it have to be children or grandchildren?
It's always better for immediate. Not necessarily. I think there is, I think you can do spouses as well. So you can do actually your son or daughter and then their spouse. So you can actually split it up to 17,000, but it is immediate. I would just stick with your immediate. It's a little bit easier to justify the gift cost. So.
Okay. A little bit of a one-off on that from a gifting standpoint. So the question from Mark, is that $17K per gift or in total?
It is in total.
Okay.
So total for the year per person.
And let me expound on that. I threw that as a little softball at Amy, but I knew she'd hit it out of the park. But Mark, along that line, because I know that you and I are talking a little bit. So let me just expand this on the gifting ability. First of all, if you're married, then your gifting ability is 2 times. And Amy, if I say anything that is inaccurate from a tax standpoint, let me know. But 20 plus years, been doing a whole lot of insurance work, and utilizing gifting ability is a really, really good way for high income earner or high net worth people to leverage assets. And then it takes it back to transferring generational wealth. From a husband and a wife standpoint, if your gifting ability is 17K, then as a husband and wife, your gifting ability is 2 times, which is 34K. And that's per individual. So, that gives you the ability to utilize those funds. And one of the ways that we would use them, or one of the planning standpoint, is use them to fund permanent life insurance that transfers death benefit tax-free to the heirs. A little bit of an estate planning thing. You got to put a trust involved and get crummy letters and things like that. But it's something that we utilize gifting for. If either I or my LLC purchases whole life insurance and the beneficiary is a charity, is it tax deductible, and can I still take loans against it if it is? I've got a little bit of an answer here, but
you can go answer yours and then I'll fill it in with mine.
Okay, so I'm going to read that again because I stumbled on the end. If either I or my LLC purchases whole life insurance and the beneficiary is a charity, is it tax deductible, which is your part of the question, Amy? And can I still take loans against it if it is? So, Sandy, this is a little bit of a little bit detailed. I don't know exactly what's going on, but let's just say if you, let's just let you be the purchaser. And I'm going to change that. There are 3, the insurance 101, but nobody ever talks about this. There are 3 components to any and all insurance policies, or 3 different people. You have an owner, you have the insured, and you have the beneficiary. And for most of the time, unless you're doing charitable estate planning or estate planning, the owner and the insured most of the time is the same person. Okay. So just use me. If I buy a policy, normally I own it. I'm the insured, and then I can have my estate, a charity, my wife be the beneficiary, my children, whoever I want to name as the beneficiary. Let me clear it up real quick. The owner of an insurance policy has all the rights, has all the authority. For example, when parents buy life insurance policies on their children, the parents normally are the owners of those policies until the children become of majority, 18 normally. So therefore, there's really no risk in your kids taking loans, borrowing the cash, surrendering the policy, because the owner of the policy, the parent, is really in control. So Sandy, in your situation, can you still take loans against it? That depends on who owns it. Okay, so if you own it, or you're the only member of an LLC, therefore you would control it, then I would say, yes, you can do that as long as you keep ownership. If you're, sorry, I know this is a little bit long-winded, but if you're listing a charity as the beneficiary, I would question you owning it, because a lot of times when I'm doing high-level estate planning for people, you could have the charity own the policy. The charity would be the beneficiary of the policy, and you could gift the premium amount to the charity and let them pay the premium. Okay. When you're doing charitable work, that's normally how it's done. Okay. And just because it gets a little bit complicated when we're talking, I'll just give you an example. A very good client wanted to give the museum $1 million cash. And I went, wait a second, you don't want to do that. And instead of doing that, we basically bought a life insurance policy with $1 million death benefit and let him gift the premium to the museum. And because it was tied to the university, in this case, the University of Florida, it was very easy. Him and his wife gifted the premium amount to the university foundation. The foundation paid the premiums. Then the policy was owned by the charity, which in this case happened to be the University of Florida Foundation. So there's an example of using a charity, and instead of just giving $1 million gift, which goes against your unified credit, we were able to do it through the use of a life insurance policy. Amy, I'm going to give you the last part, which is, can you write off life insurance premiums?
Yes, you can. As long as it's a whole life, you can run your premiums through your business, just like you would a retirement program, whether that's a 401k or anything like that. I have run the premiums through the business and taking them as a write-off. So mine was a lot more simple than hers, or than Brian's.
All right. So, Sandy, if that was as clear as mud, then click the link and schedule a one-on-one, and we can talk a little bit more about that. If we answered it well enough, then hopefully we'll be good there. Amy, I had one other question, because when you were talking about
Sure.
the auto, and Sandy said thank you, so we must have did okay on our answers. The go back to the large vehicle and the depreciation. You can do
Yes.
that over what period of time?
Okay, so the amount of time, so if you bought a big pickup truck or a bigger SUV, anything over 6,000 pounds, the goal in the previous years, you would be able to write that off in 1 year, a total 100%. Well, the IRS has now reduced that down to 80%, but there is one little loophole. You can use the 20% in the same year and 179 the other portion. So it is still at 100%. You just have to finagle it just a little bit to claim the whole amount. Now, you don't have to. I always look at your tax, situation. So it just depends on individuals. So we can take 80%, and then the remaining 20% can be over a 5-year period. So we'll just break up that last 20% over a 5-year period and do it that way. But if we need the deduction, we can turn around and use the other type of depreciation, which is 179, and take the remaining 20% all in 1 year. So I just wanted to bring it forward because it does show up on the tax return just a little differently. So if it's split up and not normal like it was the previous years that you've done it, that's going to be the reason why.
Okay, so I'm going to put that into my words, because I'm the guy who, when I go, hey, I don't want to know how you build the watch. I just want to know what time it is. What I heard was you can still depreciate a vehicle 100%. You just got to do it a little bit differently.
You have to, yes. And it will show up on the tax return. So I always get a lot of questions. So like, why didn't this show up last time we did this? Well, and then I get into the explanation that I just gave, and they're like, oh, okay. And then they move on. But I just like to know. So if people do actually look at their tax returns, and I do encourage you to do that and get to know your tax returns so you can find things like that, just know that it will show up a little differently. So if you have questions, ask your CPA that is preparing your tax return in 2023. look for differences. So
Okay, what do we got? We got 157, and I don't like to go over. So if you have any other questions, throw them in the Q&A here real quick, and we will try to hit them. And as I wait for that, I'll kind of give a little bit of a closeout here, if you will. And again, I put into the chat the link for you to schedule any type of one-on-one, or if you have additional questions, you can go to that link and put that through there. First, I want to thank Amy for, again, sharing her wisdom with us today and bringing value to all of our lives as we continue to make great financial decisions. Lastly, if you're looking for additional information or just want to schedule, again, that one-on-one meeting to discuss something, feel free to, again, click that link. That'll take you to our calendars, and you'll be able to schedule a convenient time to meet with any of our team members to discuss any specific questions. Also, today's and all of the past webinars are listed at that site. So if there's something that you heard or want to go back and listen to again, normally today's Tuesday, we do this, and around Sunday they get put up on YouTube and then get transferred over to that link, so you can go back and listen to those. Or if there's someone that you know that needs to hear this message, you can simply forward the link. Before I continue on this closeout, David threw in a question. My ex-wife and I alternate claiming our 17-year-old. It is her year. It is her year 2022. Do my taxes go up a specific amount without that deduction? Okay, and David, I'm going to kick that back over to Amy.
yes, it will a little bit, because then you now are considered single. So your itemized deduction is not as high if you are claiming head of household. So there will be a little bit of difference. We can talk more specifics if you would like, if you want to set up a time to meet with me, but it does depends on how much, just depends on your individual things that are happening. If we can mitigate that through businesses or, other ways. I do this a lot with, your situation. So we try to mitigate it in other ways. So it just depends on your individual tax things.
Okay. All right. Thank you. Again, appreciate you guys taking the time out of your day to sharpen the saw and spend a little bit of your Tuesday afternoon with us. Hey, don't forget, if you want some more money school concepts, you can tie into any of our shows. But I know that there was one that is going on tonight with a free training with Chris and Stephen Nagy, one of our #1 money mentors on our team. And then also tomorrow, Wednesday afternoon, the consistent every week Wealth Wednesday webinar. So please keep that in mind, and you can continue to tie in to glean additional information. Look forward to answering more of your tax questions next Tuesday on our upcoming episode of Shey's Way, Tax Tip Tuesdays. And if there are no other questions, which right now there's not, we are at 2:01. So have a great rest of the week, and we'll see you next Tuesday. Take care, guys.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.